Yes guys, so let's start looking at illustrations related to IND AS 40, where we'll start applying the paragraphs or the understanding of IND AS 40 into solving certain illustrations which are given along with the standard that will help you understand the standard better. Yes, after the illustrations, we'll also move into the workbook in your module 3, additions to study material in module 4, and also your compendium of solved illustrations in module 6. So first, let us start with the illustration and then we will subsequently move on to the other things. Look at the first illustration. X Limited owns a building which is used to earn rentals. The building has a carrying amount of 50 lakhs. X Limited recently replaced interior walls of the building and the cost of the new interior wall is 5 lakhs. The original walls had a carrying amount of 1 lakh. How should X Limited record the above cost? Guys, if you remember, like I told you, this is a subsequent cost on investment property. If you remember the concept of subsequent cost on investment property, it is exactly similar to what we have discussed under IND AS 60. Therefore, the cost of replacement is eligible to be capitalized and the carrying value of the replaced component is supposed to be charged to P&L. So by applying this principle, 1 lakh rupee, which is the carrying value of the original wall, should be charged to P&L, and this 5 lakh rupee, the cost of construction of the new interior walls, should be capitalized to the cost of the asset. The carrying value of the asset at the beginning was 50 lakhs plus 5 lakhs capitalizing the cost of replacement minus 1 lakh which is charged to P&L, which is the carrying value of replaced component. Therefore, the new or revised carrying value of the asset will be 54 lakhs. This is very similar to the same paragraphs that we have dealt under IND AS 16 as well. Look at illustration 2 then. X Limited purchased a building for 30 lakhs in May. The purchase price was funded by a loan. The property transfer taxes and legal costs is 1 lakh and 20,000 respectively were incurred in acquiring the building. Guys, these are incidental costs without which you cannot own the building. You have to make sure that you're paying the stamp duty or the transfer taxes, which is called in this case, and the direct legal cost. In 2021-22, that is in the same current year, X Limited redeveloped the building into a retail shop for rental purposes under operating lease to independent third party. So this is a property which is acquired with an intention to let it out under operating lease in near future. So they are trying to redevelop it into retail shops. The cost of redevelopment incurred were 2 lakh for planning permission. Without the permission of the local municipality, you cannot really go on. So 2 lakhs is necessary cost. 7 lakhs for the construction, including 40,000 rupees which are refundable taxes. Guys, refundable taxes should not be included into the cost of the asset. The redevelopment is completed and the retail shops are ready for rental from 2nd September 2021. What is the cost of building at initial recognition? What is the cost eligible to be capitalized? Now, this is an investment property for sure because it was acquired and it is being utilized for future operating leases. Therefore, it does classify or it should be classified under IND AS 40. So, this classification under IND AS 40, irrespective of whether it was 16 or 40, my costing would have been the same. How do I identify the separate cost? In case of a self-constructed asset, add all the costs. 30 lakhs plus transfer taxes of 1 lakh plus direct legal charges of 20,000. 31 lakh 20,000 is the cost of acquisition plus cost incurred on construction to bring the asset into the condition and the location in which the management intends to use the asset. They incurred another 2 lakhs for planning and 7 lakhs for construction. But this 7 lakhs includes 40,000 rupees of refundable taxes which should be excluded. Therefore, the answer should be 30 lakhs plus 1 lakh rupee of property transfer taxes plus 20,000 rupees of legal cost plus 2 lakhs of planner permission, plus 7 lakhs for construction, minus 40,000 rupees of refundable taxes. The answer is 39 lakh 80,000. Guys, it was funded by a loan. In the first sentence itself, he said the purchase price was funded by a loan. Finance charges on the loan, he did not give it, so I'm not capitalizing it. Otherwise, such finance charges would have been capitalized if it satisfies the definition of your qualifying asset. Here, illustration number 3. X Limited purchased a land worth 1 crore. It has an option to pay either the full amount at the time of purchase or can pay it in 2 years for the total cost of 1 crore 20 lakhs. What should be the cost of building under both payments method? Guys, this is the paragraph to be applied here is when the payment is deferred beyond normal credit terms. So if your payment is deferred for 2 years, then the cost would have been 1 crore 20 lakhs. In this transaction price, the cost of the asset is only 1 crore. That 20 lakhs extra that you're paying is the finance cost. That 20 lakhs of finance cost should be treated as borrowing cost under Ind AS 23. Whether it should be capitalized or not, I'm not talking about. Let Ind AS 23 talk about. But the cost of the asset for Ind AS 14 should only be considered at 1 lakh. Sorry, 1 crore, not 1 lakh, 1 crore. Illustration number 4. X Limited, a lessee has taken a building under finance lease from the owner. It classifies interest in leasehold building as investment property, and after initial recognition measures property interest at fair value. The fair value is 50,000. The present value of minimum lease payment is 40,000. What will X Limited will recognize its investment property. At what value should I recognize? Fair value is not possible. My recognition should only be as per Ind AS 116. Your Ind AS 116 applies present value of minimum lease payments, which is 40,000. Therefore, the investment property should only be recognized for 40,000. 50,000 of fair value is only eligible to be disclosed. It cannot be presented at fair value. Illustration number 5. Moon purchased a building on 1st April at a cost of 10 million. The building was used as a factory by Moon Limited, was measured at cost model. The expected useful life of the building is estimated at 10 years. Due to decline in the demand of the product, that the company does not need the factory anymore and has rented out the building to a third party from 1st April 2025. When did you acquire? 1st April 21. When did you lease it out? 1st April 25. How many years was it considered as Ind AS 16? 4 years. So I could have applied a cost approach or a revaluation approach over 4 years. On 1st April 15, when it gets reclassified from Ind AS 16 to Ind AS 40, I'll have to measure it at carrying value on the date of reclassification. Clear? Now, look at it. Fair value on the date was 8 million. He's trying to confuse us. Fair value concept is not applicable on the date of revaluation. On the date of reclassification. Should only be at carrying value. So Moon Limited cost model for accounting for investment property is 10 million over 10 years. Depreciation is 1 million per annum. 4 years it applied Ind AS 16. 4 million is depreciated. The carrying value is 6 million. So therefore, the asset would be shown in the books on the date of reclassification into Ind AS 40 at 6 million itself. Fair value is irrelevant there. That's it. That will bring us to the end of illustrations that we have discussed as a part of Ind AS 40. We'll have to look at workbook problems in Module 3, additions to study material in Module 4, and also a compendium of solid illustration in Module 6. Before we look at that, this is the end of illustrations given in the standard. These illustrations are only to help you understand the standard better, and I hope you've got a clear idea on how these have to be accounted for.